Chapter 9, Simplicity in Investing. This is the last video in this book review. We have seen in the previous videos all the 6 pillars to peak performance, and we've also applied it into business. And now in this video, we're going to apply this in investing. So starting off, there are lots of misconceptions when it comes to investing. And the biggest one is to make higher returns, you have to take higher risks. That is incorrect theory. You can make market returns by indexing, and we will see how building a coffee can portfolio, which is highlighted in this chapter, you could consistently beat the market, especially in the case of India. So Charlie Munger also shared this one, which was this quote in this chapter, which I really liked, which is, if a company generates high returns on capital and reinvests at high returns, it will do well. Simple. That's it. He says, but this won't sell books. So there's lots of fuzzy concepts that have been introduced and then that don't add much. So these two pieces of information, generating higher return on capital for non-banks and then returns on equity for banks, and if you reinvest that capital and then if your compounding engine grows, then you will do well as a company. Your market cap will grow, your company will grow, you'll do better, right? So simple, but it's hard because a lot of times our animal instincts when it comes to investing overpowers us, right? We buy assets when there's lots of buzz around it, there's lots of conversation, and typically those are the times when it is overpriced. And we sell it when it's underperforming. Like typically in our portfolio, like when we see some stocks underperforming, we have this super high itch to like change that or optimize it because we are active, like we want to do something about it. But that is giving up to this emotions or the instincts, the animalistic instincts of fear and greed. And that is what I learned in this chapter, which is to keep a portfolio untouched once it's unless the fundamentals have changed big time and you've convinced yourself. That will get us out of this misconception that I can actively make this better, because it's shown in the chapter through various examples that Asian Paints, which has consistently delivered more than 25% CAGR returns, there have been years, multiple years, where it has been like zero returns, right? So the growth doesn't come like linearly. There's cycles of ups and downs, and that variation we can only factor in it if we are investing for the long term. So the lots of misconceptions, we absolutely need to get away from these misconceptions to really make any money, and ignore our the fast brain that we have that tells us that, hey, we need to intervene, we need to make a lot of changes. It will feel boring in the early phase when you see your portfolio consistently just going up and up, and you're like, can I do better, right? So avoid that. That is the key. And the second big concept is to allocate your, like, what percentage of my portfolio should I allocate to equity versus debt versus mutual fund. That's a question that is very common. And one inspiration was taken by this book Aspirational Investor by Ashwin Chabra, where there is this allocation based on goals, like what are your goals. So reflecting on your goals is critical. What Saurabh Mukherjea and Anupam Gupta are sharing in this book is a lot of times people don't even have goals, like they don't know why they're investing. They're just investing, but they don't know why they're investing. And so, which is very true, like you might be investing, you're like, hey, I just want to make more money, but you probably need to simplify that by having goals and then changing based on goals the percentage allocation. And the inspiration, I believe, for Ashwin, is my guess, was from Maslow's hierarchy of needs, right? We all have needs at various levels. At the very bottom is the physical needs that are like, we need food, clothing, and shelter, and warmth, right, to survive, like survival needs. And so similarly, we have financial needs where we have like basic survival needs, like, hey, I need to be able to pay my rent or my mortgage. I need to be able to buy the food that I need to eat twice a day. And so those are basics. So those are like your core basics, like what is it that you absolutely need. And then the second bucket is like safety needs, like, hey, now that my today is secure, can I make my next month secure? Can I make my year secure? Can I make my 10 years secure? Right, so there's that security that you can build for. And then eventually stability, like saying, hey, can I make my investments in autopilot so that it just takes care of itself, it's growing, and then it supplements my needs, right? And then eventually like social needs, self-esteem, like mastery, and then eventually self-actualization, where you're truly living your life to your fulfillment. So those are Maslow's hierarchy of needs. Similarly, Ashwin in his book Aspirational Investor has shared buckets for us to start thinking like, hey, what if this is is my absolute minimum security needs, and what is it that I need for stability, and what is it that I need for ambition to enhance my lifestyle in an aspirational way. And depending on which of those goals require what money. So that's another piece. So you'd have to then put a dollar value or a rupee value next to, like, hey, when you need that in 15 years, that's the amount you would need. And then you'd have to work backwards to say, where should I be allocating that based on the timeline? You will get a lot of this help from a fee based financial planner who can work out all of these goals and your aspirations that you have, and advise you on which of these are the best allocations for you. What should be in what percentage should be in equity, what percentage should be in debt or mutual funds, right? Two other key minor points of learning from reading almost all of his books is that real estate is not a great investment, and they have data in Coffee Can Investing that shows by city breakdown as to how it underperforms, especially in India. To be very careful when you think about real estate as an investment. There could be 10 years where you would make no money, but then it will have a spike up and you can make 10x, right? And so then overall though, if you calculate the CAGR, it'll be way lower than 20%, absolutely. So on an average basis, right? So that was key learning. And then gold is another like non-asset, doesn't grow, it's not dynamic, it's so that those were the two. So getting a financial planner was the second biggest tip that'll help us allocate the money in the most goal oriented way. And then the key learning was coffee can investing, right? Which is what Marcellus does, and I would highly recommend Marcellus's consistent compounders. And they use these simple criteria to allocate money, and in that they manage for thousands of clients that they have. They use the company that they invest in should be of greater than 100 crores of market cap, because they believe that it's only reliable, the data is only reliable once you get beyond certain market cap. So there is much more variability and doubt in the quality of data in for smaller mid companies. So 100 crores plus market cap, that reduces the listing companies in India from 6,000 to 1,500. And then they need to be in 10 plus years of consecutive existence, meaning you don't want to just invest in a brand new company that's not been making money, right? So longer period of time of existence, and two factors after that, which is it should be growing revenue or sales. The top line growth should be at least 10% consistent for non-banks, and for banks, loan growth of 15% consistent. Um, and the second part is once you build the top line, like what is the return of deploying all of this cash? We have deployed the cash in terms of the equity that the investor has invested, and also the debt that the company has taken. So return on capital of 15% pre-tax, and 15% again on return on equity for banks. And so the return on capital employed formula is earnings before income tax divided by long-term debt plus shareholder equity, right? So if you do that, then it has to be consistent every period of 15% ROCE. And growth in sales revenue is very easy to look at from the financial statements. Um, and the way they come up with this 15 and 10% is very interesting. Look at the 10% growth in sales. They're saying nominal GDP, which is does not account for inflation, grows at 13% over the last 20 years, right? And so then they're saying a good company should be able to, without adjusting for inflation, at least grow their revenue by 10%, right? So 13 was a much higher barrier, so they downed that from 13 to 10%. And the 15% ROC comes from the fact that in India, if you invest in, like, let's say a risk-free savings account or a bond, right? You get 8% risk-free return, and on that, in US equity long term you get 4%. So absolutely, so that is also another risk free kind of investing, so that already makes up 12%. So if you have to make, you can easily make risk free return 12%, right? And that 4%, you can also think about the depreciation of currency. So 8 plus 4, 12, and then 2.5 is just a credit rating. Like India as a country would be lower in credit rating. I guess S&P has given triple B minus. So there's a risk premium added, which you're taking more risk, right? So you need to be getting more. Remember that misconception. But that only applies when you think about it in aggregate. If you have investments in great quality companies, then this is adjusted. So it's 12 point. So if you look at this, it's coming to 14.5. So it said, hey, round it out, 15% return on capital or return on equity for banks. So when you construct these kind of portfolio, what do you get? If you keep it untouched for 3+ years, the data in his book, in this chapter, and also in Coffee Can Investing, has shown 24% return CAGR. This is massive. To give you an idea, a 26% CAGR is grows your money 10 times in 10 years, 100 times in 20 years, and 1,000 times in 30 years, right? So 10 times in 10 years, 100 times in 20 years, and 1,000 times in 30 years. That is huge. That compounding growth is huge. So 24% is massive. And 3+ years, you really get that much with a very high confidence rate of 95%. And then if you keep it on for 10+ years, it's almost 100% chance, which is huge. And they've back tested this for 20+ years. And so the data is available. Coffee Can Investing as a book has a lot more of this data too. 7% outperformance over the market. Remember John Bogle, right, with Vanguard, with the efficient market theory. Doesn't look like it's applying in India though, right? Because if you can outperform 7% in the market, then that cannot stay true for a long term. But it is true based on what he has said, at least in this book. So that is the disconnect, which is in India, it's not efficient yet. The market is not efficient yet, which is why Marcellus is able to, I'm guessing, generate the 7% outperformance. So that was huge application in Coffee Can. So you can use this kind of portfolio. You can build portfolios like this easily by building these screeners, and then breaking this down. If you add all of these 4 screeners, you'll only get 20 companies, 25 companies in all of India, listed companies, right? So then you can like narrow down, say, hey, which of these companies are good? And he has published all of these portfolios of stocks that on his website and blog and in his books, consistently sharing out like all of those company names. So that's also a good starting point to build your own Coffee Can simple, powerful portfolio to invest for the long term. Again, checklist. What have we learned? Did we start off with the list of goals? Are we just investing because we want to get more money, or is there like goal based, is it purpose based, right? So you have to think backwards, that because that's important. If you don't do it, you will not allocate appropriate money in the equity segment or appropriate money in the cash segment to reserve, right? So starting off with the list of goals, working backwards, and then going all in is quite important. Having a financial advisor that does all of this planning for you, there's lots of discounting, this inflation adjustment, there's modeling, they can do this for you. And fee based financial advisor, they're not like recommending a fund to you, are quite fiduciary in their responsibility to help you. So stick to simple investments. If you cannot have the time, if you don't have the time to invest in or build your own coffee can portfolio, then stick to index funds. That's probably way better than a lot of these fee-based funds that you'll have to screen out. And avoid real estate. Avoid real estate and gold. Was the huge learning. And track your investments, but like don't track it daily, weekly, monthly, maybe quarterly at the minimum, and then a yearly, and then adjust based on the planning. So we've learned all the 6 steps, and now we've applied it. Specialize. Pick a specialization. Put your energy into worthy creative pursuit. Simplify your life. Spiritualize. You're not going to know everything that's going to happen like the next trading day, or you're not going to know what will happen to the portfolio, but you can't live in that uncertainty. Spiritualize by focusing your mind on what you can control, which is your specialization. Clutter reduction. You will have this overdose of like issues that you're facing, because if there's clutter around you, and if that bogs you down, then your mind goes into this turmoil. So reduce clutter. That'll help us to increase our creativity, because we'll be able to focus on our specialization, build memory, because that is the basis for creativity, and we will have an avenue to collaborate and apply all of these principles. Overall, highly recommend reading this book. A fantastic book for anyone wanting to get to peak potential, right? So highly recommend reading this book. Go buy the book. Hope you enjoyed it. Over the last 9 videos, 90 minutes, I've tried to summarize the key ideas, but there's so much more in the book. So I would highly recommend reading the book. I have taken lots of notes. Hopefully this inspires you to go get the book, apply it, and get to your peak potential.